Welcome back to another video, and today we're going to take a look at how we can identify trading session liquidity. We're looking at the NASDAQ, a daily chart specifically. In this specific example, I want to cover how you would go into the marketplace and still take a trade without holding firm to any specific bias. So ideally, you would be looking at the 4-hour, 1-hour to frame an idea based on session liquidity. In this case, it so just happens that I'm looking at this inversion on the daily, and Wednesday and Thursday we traded into this specific level, and we use this level to give us an extra confluence in our trading ideas. Going down into a 4-hour chart, we have this sell side, which I noted there on the lower time frame, and we'll get to that once we are in the lower time frames. You can see that we had essentially this breaker block down, high, low, higher, low, high, lower, low, up close. That's a breaker block. Extend that through. You can see that supported price. We had these order block candles over here, and it's like the lowest one. Couple to this one, pull it through, and you can see that held price firmly in line with this fair value gap on the daily time frame. Then we also have this gap down over here, and we can extend that gap through as well. There's a whole bunch of confluences around this specific level, which indicates that we are likely to get some reaction around this specific price point. That in itself does not mean anything. And we are focusing specifically on Thursday, the 2nd of May 2024. That will be our focus. Dropping down into an hourly chart. On the hourly chart, I like this consecutive down close candles. I like those candles. And if I look at this lowest one over there, which is the candle with the biggest body as well as tail, and if I were to put a line on this exact order block, it would classify as an order block, by the way, then we can see we traded right into that, and price turned around. And we also have this inversion over here as well as this one over there. So we have a whole bunch of confluences around this specific level in price. Now going down into a 15-minute time frame, this is ideally where you're going to be looking at price, and you're going to see how they work with liquidity. And that will give you a session bias that you can work with or frame a trading setup. So looking at this chart, I can see that on Tuesday we came in, we just consolidated around this daily level, and we traded up higher into these fair value gaps. We traded through these highs over there into this daily fair value gap. Up here, if I extend that through, you'll see we traded into that, and it tanked down lower. So we took all this buy side, ran into that inefficiency, and then we traded out lower. Now, before I get to that, I jumped ahead of myself. If you look at this consolidation, the high would be there and your low would be here. And then we traded the sell stops. We took those out. We then took out buy side that was on the board and traded up into inefficiencies and more buy side. And then we only had sell side on the board along with these inefficiencies and these equal lows. Price traded down into those, back into this fair value gap level. We just then from there on, since we cleared the sell stops, we took out the buy side. We only had these inefficiencies and these little equal lows over there that we could trade into. So with both sides of the board cleared, we traded up into these inefficiencies and we filled those up. So this happened in the course of Tuesday as well as Wednesday, and then we are looking at Thursday. So what would be remaining of this would be this little area in price would be inefficiently traded with buy side specifically. And we have equal highs coupled with this idea. So let's mark them out. So with all that in mind, and we traded down once more, took the sell side, clearing all these guys, all those guys, the gap, taking them all out. That only leaves the buy side in place still. Dropping down into a 1 minute. Let's go over to Thursday. All right. So Thursday morning, it was a mess. Price open up. Basically sat inside of this range the whole morning. Sat inside that range. Price took out sell side, took out the buy side. And then equal lows form right before the open. 9:30. Price traded up into this gap. Order block, took out these guys that were had their buy stops above these highs. From there on out, price tanked, market structure shift lower, fair value gap, traded into the fair value gap, filled that in, drop lower, fair value gap again, consolidation, back into that fair value gap, tank down lower. Again, fair value gap, tanked, fair value gap, tanked. Good. Okay. So you sit down, you're expecting to trade from 10 to 11, just as an example. Then you would be looking at price action. Took out these 15-minute sell side that I referred to earlier. Price took that out. You have low, high, lower, low. So that would be a breaker block as soon as you traded through that. And if we come back to it, that will be a retest. Price took out liquidity. So this down candle there would be the order block. Extended through, price traded through that. It's valid. Price came right back into it. Tapped it. Ran away. There's your order block. You can look at this inversion fair value gap over here. Extended through, price traded it here. price ran. That would be the fair value gap entry. Then you have all these highs acting as liquidity. Price then traded into that breaker block, extend that through. Just extend it through. There's the breaker block. Let's just put that mean threshold of that breaker block, and you can see price tap the mean threshold, the body's wick through, but the body's closed right above that 50%, and that gives you the narrative in play. Price also took market structure shift, took out these equal highs. That's a market structure shift. You also have this fair value gap over here, which you can pull through. You can extend that, and price rallied higher, as you would have expected it to rally higher. So basically, we framed the idea that we would have buy side liquidity in play after price took out that 15-minute sell side over here. That only leaves all this buy side and this inefficiency up here in play for price to reach to that. Now note how multiple trade entries and trades could have been taken within this piece of price, and it would not be needed to take an entry and hold it to run up into that area to be profitable. You would still be able to take a trade and get what you need and get out of that market. You get in, take what you need, pay yourself, and you get out of here. As simple as that is the logic. Since it was a week where we had tons of news events, so that means it would not be, we won't be holding firm to any bias. And you go in, you get what you need, and you get out of there. And you are done for that particular week. Now, if we just take this out, then you can see that we had this consolidation in here where they just held price past lunch, and very, very early New York session, it just started running back up, taking these guys out. And last portion, lines of the move, only happened after we closed at 4 p.m. So it was a really messy PM session that I wouldn't want to be involved in that at all. Your best trades would have been taken right at the 10. Right at 10 o'clock, 9:50, 10:10 macro. That would probably be the macro you would be referring to, unless you were trading this breaker block, which that one would be 10:50 to 11:10. Those would be the two macros that you would be looking at to take a position. So let's go ahead and frame some of these trading ideas. So 10:40, you would have to take an early entry with that one in order to get involved in that position, or you would miss that best entry point over here. You would have to take that order block over there as a second opportunity to get long. Taking the breaker block, you have a breaker block. We already had the liquidity taken out. We already shifted market structure. That is more than enough points to give you validation that this is a good trade. The stop can be right below the breaker block. You also have breaker block, fair value gap, fair value gap, fair value gap, as well as these order blocks. And so this is good enough. to put down there. So if you take a look at this, then you can see that you would have a 0.11% on the risk, and you would make a 3.5 to 1, just taking a target on this high over here, these equal highs. So if we take a look at the fair value gap entry, right there, that overlaps with this inversion over here. Entry would be somewhere in there. Stop would be below this inversion over here, or at the low of this candle right there. That should be plenty good. So we have this fair value gap coupled with a order block, coupled with this inversion. That's 3 PD arrays. Once again, we had the sell side taken. We didn't get a clear market structure shift in this one just yet. But we have these 3 PD arrays over here which hold price, and we also have this impulse move up and away from the sell side. And notice we also have the low here in play of this daily fair value gap. So stop down there's plenty good. Target 1 to 2 at least. You could look at taking something off in any one of these fair value gaps, that gap up there, or just above the high and in that fair value gap over here, which should be good. That's a nice partial. We did not get up there all the way until only later in the day after this retracement back for the 1050 macro. So you would have had to, in this case, be happy with about 2.5% made back on that. Not bad at all. That should be more than enough. Not a bad entry. For a last example, let's take a look at this order block down there. Extend it through. In this specific case, your stop has to be... Let's look at this one first, though. We have this inversion. Notice how that lines up right with this order block, extra confluence. And we also have price coming in. It didn't quite yet pull the gap that it formed. So that will be an institutional order flow entry drill. But I traded the order block. Now, with this specific move, we took out the stops. We took out higher time frame stops. We reversed. Time of day was 10 a.m. Silver bullet. 950 1010 macro comes into play. Price rallied away. Confirmed the order block. traded right back into it. We have this, which would be, it wouldn't be an inversion until we trade through with this candle. So that's a fair value gap. But we want to see that fair value gap get inverted. So we form this beautiful down candle, which is going to be, that's going to be our entry point. Entry would be around about there. Stop. In this specific case, we took out the stops. And we reel it away with an impulse. And we also traded into shifting back to the 1 hour, which I didn't take a note of this. Remember this little order block. Let's take note of that order block. Back down. Let's go back and Thursday. So right there, we traded into the hourly order block. So now we cleared the stops. We traded into the hourly order block. Price ran away impulsively with the correct time of day in favor. Trade back into the order block. There's your entry. Stop below order block. Take profit 1 to 2. It's going to be around about there. You can target this high initially, and then you could target this. I like this imbalance. It's a good area to take. Pay yourself, take something off. And by the way, as for your own study, pull a fib on this range. Pull a fib on that range. Anything below 50 is valid order blocks, valid inversions, fair value gaps. And as well as this breaker is right at the equilibrium of the range. So extending it through, price coming back into it, notice how it sat right on the 50%. Doesn't get better than that, does it? And it just barely wicked to the low of this daily. And couple that with this order block here, these two down close candles. And that all sits right on this, which would be inversion at the time when it traded through it. It comes back to it. Inversion level. Beautiful price action, how price just sat right on that and it rallied up higher and eventually traded through that. So that could be another confluence, that price was in a discount and the order block was in a discount, and that gives you a valid trade idea. You could also use this entry as an order block entry over here, because we turned it into an order block. We had fair value gap over here in this area, and we had that inversion down there. The 3 PD arrays, we also have the low of this daily fair value gap, which gives another confluence. So there's a factor of ideas and levels coming together in this play to give you a bullish bias. You get in, you take what you need, you get out of here. You don't sit there, you don't hold it thinking it's going to go to the moon or it's going to keep on going. In a week with a lot of high news events, rate folders, and FOMC, NFP, you really want to limit your exposure and you really want to manage your risk very aggressively. And you don't hold firm to a daily bias. So you go in, you frame an idea on session bias with these ideas in mind. And you get in, you make what you make, and you get out. If you take a loss, that's it, you're done. You don't go back in trying to make it back. You take a loss, you get out, you're done. You take that home and you come back another day. Capital preservation. That's the rule. Capital preservation. So I'm gonna cover it for this first little episode of this intraday, not intraday, but session liquidity trading idea. And until I see you in the next one, good luck and stay safe.